All right. I'd like to take this opportunity and discuss the last topic in this class, the modern portfolio theory. Okay. Um, and This is a very interesting, implementation in Excel. All right. So modern portfolio theory, and the objective is to implement the MPT in Excel. All right, so if you can actually implement this modern portfolio theory in Excel, then your understanding of the modern portfolio theory is actually very clear. Excuse me. And you may have discussed this chart already in Finance 310. Okay, if not, I'm going to actually replicate this chart using some specific numbers, and you can easily see how we're going to plot everything here. All right, so of course, this is going to be a little challenging because we're going to actually do number crunching. The skills, the skill sets, and the intuition. All right, so we're going to do portfolio optimization. All right, and the plotting, and intuition, from geometry. All right, intuition, from using a little geometry, and so on and so forth. Okay, so that's why I said it's actually going to be fascinating, because you can actually plot this one after this lecture. Okay, and I'm going to start with, and this chart is actually straight from the lecture note for chapter 11, and this is also from your Finance 310 class. Okay, so if you are a little rusty, or if you have not taken Finance 310, the discussion here will actually help you understand a lot better about modern portfolio theory. Okay, all right, so let me look at the setup here. So first of all, I'm going to actually say we're going to have two stocks here. All right, I'm only using two stocks here for illustration. The methodology, the skill set, that's going to be involved is very similar. All right, so I have expected return for these two stocks, and I also have the variance for these two stocks, and therefore I have the standard deviation, and because I have two stocks here, so I can actually talk about the covariance. All right, and if I want, I can also look at the correlation coefficient between these two stocks. Okay, so let me just provide the numbers. 7% for stock A, and the 15% for expected return for stock B. All right. The variance is 0.06064 for stock A, and 0.0196 for stock B. Okay, so stock B has better expected return, and it's also having higher variance. And if I want to get the standard deviation, I take the square root of the variance. Okay, so 8% standard deviation for A, 14% for B. All right, and let's just provide you with the covariance, and that's the number here, and therefore I can actually get the correlation coefficient, which is the covariance divided by the product of the standard deviations. Okay, all right, so that's 10% correlation coefficient. All right, so if that's the case, my question number one is, consider the risky portfolio that can be formed using A and B. All right, so the question is, how many risky portfolios can you form by using two risky assets, A and B here? Well, the answer is, all right, question, how many risky portfolios can you form? All right, from using A and B. Well, the answer is very simple, infinite. All right, so modern portfolio theory, some other times people refer to this as portfolio selection theory. So if you think of the jobs for like a mutual fund or a hedge fund, what is the best portfolio they're going to actually construct? Okay, how much do they allocate to, for instance, stock A, stock B, and the stock C, and so on and so forth. Right, so they're choosing the best of portfolio. But the question is, how do you define the best? All right, and if you look at the universe of the risky portfolios you can form, well, first of all, there are so many risky assets. Okay, so for example, you can look at equities. All right, that's a separate asset class. Okay, so you have a few thousand stocks that are actively traded. And you can look at bonds. Now, the number of bonds, that's actually far exceeding the number of stocks. You may have over 10,000 different bonds issued by different entities like a government, corporations, municipal governments, federal government, and corporations, and so on and so forth. Okay, so they have different bond ratings, they have different coupon rates, and so on and so forth. All right, so fixed income securities, that's another asset class. And then you can talk about, for instance, real estate market. All right, you can talk about cryptocurrencies. Okay, like bitcoins. All right, you can also talk about foreign, equities, foreign, fixed income securities, foreign bonds. You can talk about large commodities like gold, silver, natural gas, oil, and so on and so forth. All right, so there are just so many different assets and asset classes. So how do you pick the best one? All right, so how do you define the best one? Okay. So that's why we're trying to actually label this as portfolio selection theory, because we're trying to actually gain some insights into how mutual fund managers or hedge fund managers can actually select their desired portfolio. All right, so back to square one, ground zero here. How do you actually form different risky portfolios using these two risky assets? Okay, remember, a portfolio is defined by, number one, the assets you can include in the portfolio, and number two, the weight. So here I'm going to actually look at the weights on these two stocks. All right, so let me start with zero for stock A, and every penny into stock B. All right, so however much I have, I'm just going to put everything into stock B. Maybe I was looking at the better returns. All right, so this is a portfolio because I have the elements defining this portfolio. I have two assets here, I have the weights. Okay, so now I'm going to look at the standard deviation of this portfolio, and I'm going to look at expected return of this portfolio. All right, well, without any calculation, you know the answer already. All right, so if you do not diversify, if you invest in stock B only, you're just going to get 50% expected return, and the price you're paying is 14% standard deviation. All right, but I want to actually consider a robust formula here so that later I can actually construct more risky portfolios and I can plot them. All right, so I need to actually build a strong formula and copy it down. All right, so I'm going to look at the weights, okay, and I'm going to look at the expected returns, and because I want to be able to copy down, so let me lock down the expected returns. And yes, I got 15%. Okay, and notice that the weights add up to 1 because I actually do the weights on B as 1 minus the weight on A. All right, so the weights add up to 1. So the question here is, what is the standard deviation? All right, remember in the previous lecture on risk and return, we discussed how to calculate portfolio variance, and our only approach is the variance covariance matrix. So let me construct a variance covariance matrix, using A and B. All right. Okay, so I'm going to look at stock A, stock B, and the stock A and the stock B. All right, so this is a very simple to construct variance covariance matrix because it's a 2x2 and we have all the numbers. So that's the variance for A, all right? And this is the variance for B, okay? And this is the covariance. So that's this number here. And this also is the covariance and it's symmetric. So this is the variance covariance matrix. And now I can actually look at my high-tech formula here. So watch me closely. If you are still a little, confused, please review the risk and return, discussion, as well as a little separate video on how to calculate portfolio variance using the matrix multiplication in Excel. Okay. So I'm going to do a square root of the variance because I'm calculating the standard deviation, all right? And I'm going to do a matrix multiplication, another matrix multiplication. I'm taking the weights, okay? I'm making a sandwich, all right? So this is the portfolio weight on the left, and then the variance coverage matrix in the middle because I want to be able to copy down. So let me lock down the variance coverage matrix, and then in order for me to actually, be able to do matrix multiplication, let's make sure, the conformity condition is satisfied. So I need to have a 2-by-1 here now. So let me just transpose the weights. Okay. So close the transpose, close the, outside matrix multiplication, close the square root. Right. Control Shift Enter, and yes, that's 14% standard deviation. All right. So we are replicating the, risk and return, for stock B. All right. So this is our first portfolio. Now, is this portfolio a good portfolio? Not necessary. All right. So, you would have to define, first of all, what is a good, all right? And how do you compare different portfolios? All right. So I'm going to move away from, not diversifying because we know there is diversification benefit. So I'm going to actually, this time, I'm going to, put 10% of my money into stock A. And as a result, I'm going to invest 90% in B. All right. They still add up to 1 by construction. And I'm going to look at, this is my second portfolio. And I want to look at what's the return, what's the risk. Okay. And I just build strong formulas so I can copy them down. All right. So if you want, you can actually double click and look at what Excel did here. All right, so that is the second portfolio now. All right, so this second portfolio has 14.20% expected return. So the return is actually slightly, lower than the return on B, and the standard deviation is actually slightly, lower as well. I wouldn't say it's slightly. All right, so that is the second portfolio, and now I can actually, construct more portfolios here until I'm completely the other way around. All right, so this is investing everything in A and nothing in B. And of course, I'm just going to get 7% expected return on A, and I'm paying 8%, standard deviation price for, A as well. All right, so I can now plot these portfolios into, into a graph. All right, and I want to, actually put the standard deviation on the x-axis, and I want to put expected return, on the y-axis. So I'm talking about, the standard deviation expected return plane. All right, a plane, it's a geometric term. All right, so let me just go ahead and highlight all these numbers I want to use for my plot. Okay, and go to insert, recommended chart, and I can do a scatter plot. All right, so if I do a scatter plot, I actually have all these duds. Each dud is corresponding to a portfolio. We have just constructed. All right. So how many portfolios have we constructed? Well, we constructed 11 portfolios from row 18 to row 28. That's 11 portfolios, and you have 11 duds here. And some of you will say, can I actually connect all these duds? The answer is, of course. All right. So what you can do is actually click on the chart area and bring back, selected data, change chart type. Okay, change chart type here. And now you see that you're actually doing a scatter plot. And you can actually pick the second one, which is actually scatter plot with smooth lines and the markers. Okay, you can also pick the third one, and you just, get rid of the markers. Okay, so it doesn't matter. I can pick the second one here and click OK. So now I can actually say, excuse me, this is my portfolio opportunity set. Okay, so that's something you have discussed in your Finance 310 already. All right, so the portfolio opportunity set, all right, so let me just define this. portfolio opportunity set is the set of all risky portfolios you can form using A and B. All right. So this is a very famous shape. All right, and modern portfolio theory was first developed by a guy named Harry Markowitz when he was actually writing his doctoral dissertation at the University of Chicago. All right, and then of course many years later we're still discussing his framework. Okay, so you can see how smart this guy has been. All right, I believe when he was doing that he was like 25 years old. All right, so that is the the first step. All right, the risky portfolio opportunity set. Okay, so the question is, should we actually focus on all the risky portfolios? Okay, all right, so if you're a hedge fund manager, if you have 2 assets, you can actually form so many portfolios. If you have 500 assets, well, you can actually form as well infinite number of portfolios. The question is, are we going to be interested in all of them? The answer is no. All right. We will only be interested in some, of it, in some risky portfolios. Okay. And let me just, provide you with the answer, and let me actually, elaborate in a second. All right. So this is my second question here. Should we focus on all of them? The answer is no. We should only focus on some of them. All right. So first of all, notice that this shape or this curve, protrudes to the left. Okay. So to the left, and there is a leftmost portfolio. All right. So if you want, you can actually, identify, this point here. And this portfolio, what's the feature of this portfolio? Well, this portfolio is actually the leftmost one, meaning this portfolio has the lowest standard deviation because the x-axis is the standard deviation, all right? So this portfolio has the lowest standard deviation. And of course, because the standard deviation is the lowest, this portfolio has also the lowest variance among all risky portfolios. And because for this, we call it minimum variance portfolio. All right, and this is denoted by MVP. Okay, so we have the minimum variance portfolio. And why are we talking about this minimum variance portfolio? Because this minimum variance portfolio is actually splitting this portfolio opportunity set into 2 parts. The first part is starting from the minimum variance portfolio going upward, all right, the upper half, okay? And then the second part is starting from the minimum variance portfolio going downward, all right, the lower half, okay? So how do we find the minimum variance portfolio? To find the MVP, all right, you can actually use 2 ways to find the minimum variance portfolio. Method 1, use the formula, okay? All right, so for a 2-asset portfolio, we actually have a formula, and this formula is actually only for a 2-asset portfolio. So I'm going to skip the formula approach. All right, you can find the formula in the lecture notes. All right, and method 2, I'm going to actually use Excel solver. Okay, so we have already discussed Excel solver, and back in time value for money and discounted cash flow chapter, we discussed how to use solver to find solutions to different cash flow problems. And here we're going to use Excel solver to actually find the minimum variance portfolio. So I'm going to guess step 1. I'm going to guess the weights on A and B. All right. I'm going to guess the weights on A and B. Okay. So let me take the guess. All right. Weight on A. And weight on B. Okay, and let me just guess 2 numbers here. So how about 0.4 and 0.6? Okay, watch me closely. I'm actually doing something that's actually slightly different, from what I did earlier for the portfolio opportunity set. Earlier, when I look at the weight on A, the weight on B is actually 1 minus the weight on A, all right? But here, I'm actually doing the weight on A and the weight on B separately, okay? And this is a portfolio, all right? So I'm going to look at portfolio standard deviation, and I'm going to look at portfolio expect return, all right? And can I just copy these two formulas here? All right, and can I copy and paste? And yes, you can do that. And if you put 40% of your money in A and 60% in B, all right, we're actually looking at this row here, and that's actually, replicating the same number, okay? And I need to actually do, one more thing, sum of weights, because I'm guessing 2 weights here, so I need to actually check, after the optimization program, the weights should actually add up to 1, all right, which in this case is 2 for now because I happen to guess 2 numbers that actually add up to 1, all right? So that is, the step 1, I take 2 guesses, and the step 2, I finished the step 2 already, but let me just finish the note, all right? Step 2, use the guess, all right? Use the guess, the weights to calculate portfolio standard deviation, all right? So that's a step 2, and we did that already. We just copied the formula from the previous portfolio opportunity set calculation. All right, step number 3, I'm going to invoke solver. All right, I'm going to set, I'm going to minimize. All right, remember the minimum variance portfolio is the portfolio that has the lowest variance. So I'm going to actually, to find it, I'm going to minimize the portfolio standard deviation, which is actually portfolio standard deviation, by changing the weights. Okay, remember, the portfolio managers, they can always, decide what to put on A, what to put in B. All right, subject to any constraints. So S dot T dot, that stands for subject to. Okay, subject to any constraints. So here, I'm going to actually set C44 equal to mean. I want to minimize, all right, by changing the guesses. Well, I have 2 guesses here. That's A44 through B44. All right, so these are the 2 guesses. And I do have the constraint that the weights add up to 1, which is F44. All right, so that's going to be the setup for my solver. All right, I want to actually minimize the portfolio standard deviation by changing the weights. The portfolio managers, that's their weapon. All right, they can actually, fine tune what to put in A, what to put in B. Right. So let me go to solver here, and this is my objective cell. I'm not solving. I'm actually minimizing. All right. So check this to be mean, and I want to do this by changing the guess the weights, and I do have a constraint. So I'm going to add. The constraint is that the portfolio weights add up to 1. All right, so that's going to be my optimization program here. So this is now, portfolio minimization, right? And I can click solve here, and the solver says I found a solution here. If you just want to have the lowest risk using these 2 risky assets, you can do that. So approximately 78% in A and 22% in B. All right, and if you do that, this is going to be providing you with the lowest. All right, so so the MVP. All right, let's just recap. The solver solution. All right, has 78% and 22% in A and B, respectively. Okay. And let's look at the risk and return features of this minimum variance portfolio. All right, the minimum variance portfolio has expect return of 8.78% and a standard deviation of 7.29%. Okay. All right, so that is the technical details about finding the MVP. Okay, so at least we have a portfolio that's about 78 versus 22. So the closest one we have here is actually this one. all right, 80% versus 20, and that's the, closest one, to the minimum variance portfolio in our illustration for the portfolio opportunity set, okay? All right, so the next question is, all right, so the MVP splits the portfolio opportunity set into two halves, all right, the upper half and the lower half, okay? So because the MVP is the leftmost of portfolio, all right? So, now we're going to talk about something called portfolio dominance argument, right? So by applying the portfolio dominance arguments, all right? So there's a lot of note here, okay? But that's okay. I think it's actually useful for you to understand the intuition, all right? So by applying the portfolio dominance argument, we should focus on only the upper half. All right, why is that? That is the, starting from the MVP and going upward. All right, in other words, the upper half of the portfolio opportunity set. Why is that? Because you can actually apply the portfolio dominance argument. Okay, so let's say you pick a portfolio in the lower half of this opportunity set. All right, so I can actually say, you know what, you don't have to pick this one because you have a better choice. Okay, what is the better choice? So if you pick any portfolio on the lower half, all right, I'm going to do a vertical line, okay, that crosses the a portfolio you pick, and this lower this vertical line is going to actually hit the upper half. All right, and therefore I have identified another portfolio, and the other portfolio has the same standard deviation because it's a vertical line, but it has a higher expected return because it's actually higher than the portfolio you picked from the lower half. Okay, so in other words, the portfolio I identified that dominates the portfolio you picked from the lower half. All right, so I should actually say, portfolio A dominates portfolio B if A has higher expected return and it's the same standard deviation as B. All right, or alternatively, A has a lower standard deviation and the same expected return. Okay, so these are two ways for you to actually understand portfolio dominance. All right, so A dominates B if A actually has the same expected return but lower standard deviation, or the same standard deviation but higher expected return. All right, so in this case, I just eliminate your portfolio, the portfolio you picked from the lower half. If you pick another one from the lower half, I can do another vertical line and I can actually find another dominating portfolio. The other dominating portfolio is going to kill the portfolio you picked from the lower half. So if I push this argument to the limit, so any portfolio you pick from the lower half, I can always find another better portfolio in the upper half. And the other better portfolio is going to dominate, the portfolio you pick from the lower half. So in this way, we don't have to actually look at the lower half because all the portfolios in the lower half, they are dominated portfolios. So we don't have to, focus on them. All right. So, we should only focus on the portfolios, on the upper half. And what do we call this upper half? Starting from the MVP, all right? And we call this upper half the portfolio efficient frontier, okay? So in other words, now I actually narrow it down, in the first, in this particular step, all right? We started with the universe of the viscous portfolios you can form, and now we have this, a well-known shape, and there's a leftmost portfolio, and now I'm saying, you know what, you don't have to look at the lower half because those are bad portfolios. Those are dominated portfolios. We should only look at the upper half, all right? So the question is, which one? All right, so, that is, so the next question is, or I should actually, slow down here a little bit. All right. So, in other words, okay, the portfolio efficient frontier is the collection of all efficient, all efficient portfolios. All right. So, now I have to define what is portfolio efficiency. All right. So this actually is related to, the portfolio dominance argument I just, explained. All right. So to define portfolio efficiency, I should say a portfolio is efficient if, all right, for a given standard deviation is expected return is the highest. Or, there's another way, for a given expected return, its standard deviation is the lowest. Okay, so that is the way for us to understand portfolio efficiency. Okay, so quick question. Is the minimum variance portfolio efficient? Well, the answer is yes. Why? Because out of all the portfolios that deliver 8.7778% expected return, the minimum variance portfolio has the lowest standard deviation. So by construction, that portfolio is efficient. All right, yes. Okay, because because out of all portfolios that deliver the 8.78% expected return, right, the MVP has the lowest standard deviation. Okay, so that is an efficient portfolio. All right, so can I actually find another efficient portfolio? Okay, so can we find some other efficient portfolios? The answer is of course. All right, so I'm going to actually do one example. All right, so I'm going to actually use solver. I'm going to use solver to identify one efficient portfolio, and once you understand this methodology, you can actually identify more efficient portfolios. Okay, use Excel solver to find one efficient portfolio. Okay, so let's see how we can actually get this done. All right, so I'm going to actually guess the weights on A and B. All right, and I'm going to actually guess 0.2 and 0.8. Okay, and this is a portfolio, so I can look at the portfolio standard deviation, and I can look at portfolio expected return. All right, and I want to actually look at the sum of the weights. So in this case, it happens to add up to 1. All right, so 20% plus 8%. And remember, if you want to identify efficient portfolios, you have to fix one leg, one side. Either you fix the expected return or you fix the standard deviation. So here, all right, here you can choose to fix either the return or the standard deviation. All right, so here we choose to fix the the expected return. All right, so let's actually specify a target expected return, and let's just put down some numbers here, and this is 0.0923. Okay, so don't ask me where this number is coming from. All right, I just want to make a simple illustration. All right, if you look at the minimum variance portfolio, that expected return is 8.78. So you might want to specify something higher than that, which is the case here. Okay, so I'm going to actually look at my portfolio expected return and standard deviation, and I'm too lazy to actually apply the the formulas to calculate these two things. So I'm just going to copy down again. All right, so this is 11.47 and 13.4 respectively. All right, and that's actually, yes, it's replicating the one we have just identified in the portfolio opportunity set. Okay, and now I can actually use Excel solver to make it efficient. All right, so invoke solver to make it efficient. How? All right, we're going to actually specify the expect return, and if you want to make this portfolio efficient, this portfolio has to have the lowest standard deviation. All right, so you're going to set C65 equal to mean by changing the guesses, all right, the weights, okay? So A65 colon B65 subject to the constraint that number one, the weights add up to 1, all right? So that it's a well-defined portfolio. And number two, the portfolio expected return in D65, that should be equal to the specified level, which is 0.0923, okay? So that's going to be your optimization program now, all right? This is because we want to identify an efficient portfolio, and this portfolio is efficient in the sense that, for the expected return of 9.23%, this portfolio has the lowest standard deviation, all right? So let me just go to solver now, and I'm going to, solver is taking me back to the previous, setup. So let me scroll down here. This is my objective cell. I want to minimize this, and I want to do this by changing the weights, okay? And I do have the constraint that the weights need to add up to 1, but this actually was from the previous solver illustration. So let me change it, all right? So the weights summation is actually here, and this should be equal to 1. And I do have another constraint, so I just click add, all right? And the constraint is the portfolio expect return should be equal to 0.0923, okay? And that's the only constraint we have. So let's get back to our solver parameters, okay? So we are trying to minimize the portfolio standard deviation subject to the constraint that the weights add up to 1. The expected return is as specified. And our changing variables are the weights, okay? We are portfolio managers. All right, so click solve. And you see that solver says, I found a solution here. And if you want to actually, make this portfolio efficient, all right, and, you should actually look at, about 72% in A and 28% in B. And you're going to have the lowest standard deviation out of all the portfolios that deliver 9.23% expected return, okay? All right, so that is, what we have so far. All right, so question number 3. Which risky portfolio is the best? All right, so now we know that we should, limit ourselves to the, the upper half of this portfolio efficient frontier. And the question is, there are so many efficient portfolios out there. Which one is the best? Okay, so the answer is, all right, this can be answered by, we need to introduce the risk-free asset. Risk-free, not risky-free, all right, risk-free asset, okay? So I'm going to actually scroll all the way up to my, setup, and I'm going to actually provide you with a risk-free asset here. All right, so risk-free asset, the risk-free rate is 2%, and the variance is 0, of course. The standard deviation is 0, of course. The correlation coefficient between risk-free asset and any risky asset, that's 0. All right, so now I can actually start to think about, hey, which one is the best? Okay, and now let's look at investors, portfolio selection problem. All right, investors can now, decide how much to put in risk-free asset, all right, risk-free asset, and let me just call it F, and how much, I should say, risk-free asset versus, risky portfolio. Okay, let me just call it P, all right? And, in this case, we're talking about complete portfolios, okay? And, we call the resulting portfolio complete portfolio, and we called it C because this portfolio is now complete in the sense that it has risk-free asset in it. But I like to emphasize that the complete portfolio itself is still a risky portfolio. All right, we call it complete because it does have risk-free asset in it. All right, so one way for me to denote this is the complete portfolio has risk-free asset and a risky portfolio. All right, so that is the complete portfolio, and how do we pick the best one? All right, so I need to actually develop some intuition here, and I'm going to actually pick, start with arbitrary pick. All right, start with arbitrary risky portfolio, and we just call it a P here. And which one? Well, we have all these risky portfolios for you to pick from. So I'm just going to pick the one in this row. Let's say which one. So it doesn't matter really. But I'm going to actually look at the 90% versus the 10%. Okay. So let's say weight on A and weight on B. And you have the risky portfolio P, standard deviation, all right, and risky portfolio P, expect return, all right, and based on this, we're going to form complete portfolios, okay? So I'm going to look at the weight on A, and I just made an arbitrary pick, all right? So let me copy everything and paste it down here. All right, so this is the one I pick. Well, of course, this is not working, so let me just pick 0.1 and 0.9. All right, so everything is good. So this is the arbitrary pick, and now the question is, can we do better? All right, is this the best pick? Is this the best risky portfolio? All right, so in order for us to understand this part, so consider the complete portfolios. All right, complete portfolio C that has risk-free asset and risky portfolio in it. All right, so I'm going to actually consider the list of such complete portfolios. All right, so imagine I can actually have a list of complete portfolios that has F and a P in it. So I'm going to actually look at the weight on risk-free asset and the weight on risky portfolio. All right. And I'm going to look at some interesting cases where I put a -2, all right, and I put a +3, okay? So what is this? So some of you might be asking me, how can you actually have a negative weight on the risk-free asset? Well, think of this as borrowing, all right? So you're actually borrowing money, or you're actually selling short the risk-free asset, all right? So you actually use the, borrow the money to invest in risky portfolio. So why do you want to do that? Well, you just want to expand your purchasing power for risky portfolio, all right? In other words, you're using leverage, okay? So we know that in the real world, you can actually do some kind of buying on margin. So you can borrow money from your broker and combine that with your own money and buy more shares because you have borrowed the money from your brokers, okay? So I can look at complete portfolio standard deviation and complete portfolio expect return. All right, so how do I do that? So complete portfolio expect return, well, that's easy. So I look at risk-free weight multiplied by risk-free rate, and that's actually 2% here, and I'm just going to lock down the 2%, okay? And then I look at the portfolio, risky portfolio weight multiplied by risky portfolio expect return, and that's the 7.8%. All right, so if I invest in this manner, I get, of course, very high returns. All right, why? Because I'm leveraged. I'm using leverage. And so how do you calculate complete portfolio standard deviation? Well, the only way we have, I have taught you is to look at the variance covariance matrix. Now, using F and P. All right, so this is now not the same as the variance covariance matrix we constructed earlier using A and a B. All right, if you use A and a B, you're forming risky portfolios. Here, we're not forming risky portfolios. We're actually forming the complete portfolios. So let me do F and P and F and P. All right, so now you see that this is a very interesting variance conversion matrix because this is 0 because it's actually risk-free. All right, and this is the variance for risky portfolio, and that's the standard deviation squared. Okay, and this is the covariance. Well, we know that's 0 because the risk-free asset does not co-move with any other risky asset. So it's a very interesting variance covariance matrix. All right, so this matrix actually indicates that the only source of risk in your complete portfolio is coming from the risky portfolio P. All right, so there's only one number that's not 0. Okay, all right, so now I can actually do the high-tech formula square root of the variance, and that's going to be matrix multiplication again. All right, so I'm taking the portfolio weights, I'm taking the variance conversion matrix, I need to lock down that matrix, and then I need to actually transpose my portfolio weights, okay, and close the transpose, close the matrix multiplication, close the square root, okay. So if I do that, I get 22.41%. So yes, this is a very interesting complete portfolio because it has very good returns, but at the same time, you are actually using so much leverage, so it's actually very risky. The standard deviation is actually 22.41%. So this is one complete portfolio we can actually look at. All right, so I'm going to look at more complete portfolios. So you might be wondering, where are we going with this discussion? All right, the answer will be clear in a second. Okay, so I'm going to copy this down here. So this is another complete portfolio. It's still leveraged, but it has lower leverage because I only borrow less. All right, and I can actually look at what is the expected return and the standard deviation for this complete portfolio. And now I can actually copy down here until I have some interesting whoops, this is probably not enough. So let me just keep copying down here, and I'm going to have a very interesting portfolio where I put everything in risk-free asset and I put nothing in the risky portfolio, and I call this my grandma's portfolio. All right, my grandma is an old lady and she's really, really risk averse, so she does not want to touch any risk. So she's putting everything into the risk-free asset. And of course, there's no risk and she's only getting 2% return. All right, so now I can actually look at, okay, plotting this, complete portfolios onto, the same chart we had earlier. All right, so I'm going to actually copy this chart down here. Okay, all right, I'm going to copy this chart down here, and I'm going to actually do another plot here. So let me just say select the data here, and I want to actually have another series here. So let me scroll down here. Let me add another series, okay? And we call this, all right, arbitrary pick. Actually, it's called arbitrary capital allocation line, all right? So I'll explain that in a second, all right? And the X variables are the standard deviation, all right? So the standard deviation for the complete portfolios. And the Y variables are the expected return. So I'm going to look at expected return for the complete portfolios. And let me actually press enter and click OK and click OK. And now you see that you actually have two series here. And if I want, I may actually want to bring back the labeling for the series. So yes, let me do that. All right. So let me actually change this first series to the portfolio opportunity set, okay? And the second one is the arbitrary pick, all right? And can I have the what is it? Legend. All right, so I just put back the names here. So now you see that actually I want to get rid of the markers. Okay, so let's just change, right click, change chart type, and I want to actually get rid of the markers. Okay, so this is now saying if you just pick the portfolio, risky portfolio P, that's actually, investing 90% versus 10%, then this is what you're going to have. Okay, so the question is, can you do better? All right, so can you do better than, this capital allocation line? All right, so now let me talk about capital allocation line here. All right, so the capital allocation line, it is the collection of complete portfolios you can form by using risk-free asset and the risky portfolio P. Okay, so now imagine, can I do better than this one here? And what do you mean by doing better? All right, so let's say somehow I can actually plot another capital allocation line that's actually above this, orange line here. If that's the case, why the other, the higher, capital allocation line is better? Well, remember, every point on the capital allocation line is a complete portfolio. So again, I can actually apply the portfolio dominance argument. So if you're telling me the orange line is the best one, I'm telling you, no, that's not the best one. Why? Because if you give me any complete portfolio on the orange line, I can actually draw another. I mean, I can't do this, drawing here. This is in Excel. If I were actually, be able to drawing, this would be great. All right. So if you can actually, draw another capital allocation line that's actually above this orange line, then for every portfolio you identify in the origin line, I can always find another better complete portfolio, in the sense that they have the same standard deviation, but they have higher expected return. So now the question is, where do you stop this? Okay, imagine you can actually do another higher, and eventually you're going to draw the capital allocation line that's actually tangent to the portfolio efficient frontier. All right, so again, by applying the portfolio dominance argument, all right, the best feasible capital allocation line, we call this Cal star, all right, CAL stands for capital allocation line. It's called capital allocation line because now you're actually allocating, your capital between risk-free and risky portfolio, all right? So Cal star, all right? So the best feasible capital allocation line will be tangent to the, portfolio efficient frontier, okay? So that's the best one, has the highest Shup ratio, okay? So the Cal star has the highest Shup ratio, and this actually is the Shup ratio for the risky portfolio, okay? So in other words, imagine you're holding one end of this capital allocation line. You're trying to lift this capital allocation line as high as possible. And, the slope of this capital allocation line is actually the Shup ratio of the, risky portfolio. Okay, it has the highest Shup ratio, of the, of the risky portfolio. Okay, so if I want to, all right, and if I want to actually identify the optimal risky portfolio, all right, the best risky portfolio is the tangent portfolio, all right, in this case. In other words, when this capital allocation line is actually becoming tangent to the portfolio efficient frontier, the resulting portfolio is the optimal risky portfolio, all right? So how do we find this, okay? To find the optimal risky portfolio, all right? So let me just denote this by ORP. All right, if you want to find the optimal risky portfolio, I'm going to use Excel Solver, okay? So I'm going to look at the weights on A and the weights on B, and I'm going to look at this risky portfolio standard deviation, and I'm going to look at risky portfolio expected return, And one more thing, I'm going to look at the Shup ratio of the risky portfolio. Okay, and I'm going to make sure the weights of the add up to 1. All right, so I'm just going to put 0.6 and 0.4. All right, and I can actually copy the calculation I did earlier. This is doing the calculation for the risky portfolio expected return and a standard deviation. All right, now more importantly, we're going to have the Shup ratio, because we know when the tangency happens, the risky portfolio has the highest Shup ratio. All right, so I'm going to look at the Shup ratio, which is actually defined as expected return minus risk-free rate divided by the standard deviation. All right, so that is the Shup ratio for this one here. Okay, and of course I need to check the weights summation. All right, so it happens to be 1. All right, so this is my step number 1. I guess the weights and I calculate the Shup ratio. All right, so now I'm going to invoke solver. All right, what do I need to do? Okay, I need to actually maximize the Shup ratio. All right, I want to actually have the highest Shup ratio. And the way I do this is by changing the guessed weights. All right, so that's A109 colon B109. I want to actually fine tune the weights on A and the B, subject to the constraint that weights add up to 1, which is actually G109 is equal to 1. Okay, so if I do that, I'm going to have the best risky portfolio. All right, again, the intuition is actually from drawing a lot more capital allocation line until the capital allocation line becomes tangent. All right, so it becomes tangent, and if you actually want to go even higher than the tangent capital allocation line, well, that's not feasible. Okay, so that's why we say the cow star is actually the best feasible capital allocation line. All right, so let me go ahead and solve this optimal risky portfolio here. All right, so my objective cell is this Shup ratio, and I want to actually maximize this now, and I want to do this by changing the weights. Okay, so these are the two weights, and I do have the constraint that the weights add up to 1, and I can delete this here, and the weights add up to 1, so I need to change this one here. So the weights summation is actually in this cell, and let me get back to solver parameter. And yes, this is now our optimization program to find the optimal risky portfolio. So click solve. Oops, solver says I can't find a solution here. There might be something wrong. Okay, so let me get back and let's just look at our setup here one more time. All right. I think I actually need to maximize this. I don't know why it's actually taking me to the value of 0. All right. So I need to actually maximize the Shup ratio. And I need to do, the constraint. I need to actually check my changing variable. All right, so that is good. So click solve. Solver says I found a solution here. If you want to have the best pick, you're going to put about 52% and 48% respectively in A and B. All right, so optimal risky portfolio, and let me call this ORP, has 52% and 48% respectively in A and B, okay? And the ORP has an expected return of 10.85 and a standard deviation of 8.26, all right? And the highest Shup ratio of 1.07. All right, that is by construction. Okay, we maximize the Shup ratio, and that's actually the best Shup ratio you can ever have. All right, so now let's confirm the tangency. All right, so how do we confirm the tangency here? So now I'm going to use the risk-free asset and the ORP to plot the cow star. Okay, so in other words, now I know if I'm a fund manager, if I have these two risky assets, I have the optimal risky portfolio that says 52% goes to A, 48% goes to B. That's my best choice. All right, if that's the case, the best feasible capital allocation line should be tangent to the portfolio efficient frontier. All right, so let's actually verify this now. Okay, so I'm going to look at the weight on F, and I'm going to look at the weight on ORP, and I'm going to look at the complete portfolio expect return standard deviation. All right, and complete portfolio expect return, and let's look at this one here. Okay, so I'm going to put -2. Again, I'm highly leveraged. All right, 1 minus -2. All right, so I'm still using a lot of leverage. All right, so you know, the question is, do you want to do that? Well, that actually is bringing us to the last part. Okay, so hang on to that. All right, so the expect return is going to be the weight, risk-free asset times the 2% risk-free rate plus the weight on ORP times the expect return on ORP, which is this number here. I need to lock down this number. All right, and then the standard deviation. Well, can I copy? Where is it? Can I copy this number here? All right, and put it down here. Okay, let's just look at this one here for a second. All right, so I'm taking the sandwich formula. This is the weight, and I'm looking at the variance covariance matrix, and that's the one we have here. All right, so that's good. So we have, okay, whoops, did I just pick the wrong one here? All right, the expect return is 10.85. The standard deviation is actually 24. All right, I think the formula I just copied is actually not the right one. Okay, so because the the variance covariance matrix needs to be reconstructed. All right, so I'm going to actually do the variance covariance matrix using risk-free and ORP here. Okay, so we have risk-free and optimal risky portfolio, risk-free and optimal risky portfolio. So this is 0, 0, 0, and this actually is the optimal risky portfolio variance. So that's the standard deviation squared. Okay. All right. So now I can actually do this calculation. All right. So that's going to be equal to the square root of the variance, which is coming out of the matrix multiplication. So that's the portfolio weight matrix, and this is the variance covariance matrix. I need to lock this down. All right. And then I have the portfolio weight matrix. Okay. And close the portfolio weight matrix and close the outside matrix multiplication, close the square root. All right. So if I do that, I get 24.79. All right. So that is now the correct portfolio standard deviation. Right. And I can actually build more complete portfolios. Okay. So each time I'm actually reducing my leverage, and that is the new weights here. Whoops. What did I do? All right, I should actually copy these down here. Okay, so 1.8 and negative and 2.8 positive. All right, so I can copy this down here. So this is the second complete portfolio you can actually construct. All right, so I can actually copy this down, and I have all these different complete portfolios. And let me actually copy down all the way to my grandma's portfolio. Okay, and that's my grandma's portfolio. And now we can actually plot these complete portfolios into the same chart we had earlier. All right, so how do we do that? So I'm going to copy this chart. I'm going to put it down here. All right, and let's now see whether there's any tangency. Okay. So right click on this chart and do select the data. All right, and I'm going to add another series here. So let's click add. All right, and let me call this, cow star. All right, so this is the best feasible capital allocation line. The x-axis is the standard deviation. Okay, the y-axis is the expect return. All right, and I can now click OK. And click OK, and yes, you see that there is tangency here. Okay, so this is the best feasible capital allocation line because if you pick any one from the orange complete portfolio or capital allocation line, I can do a vertical line and hit the best feasible one, and I'm going to identify another better complete portfolio because they have the same standard deviation, but they have higher expected return. All right, so that is the portfolio opportunity set. I should actually change the title here now. All right, the tangency portfolio. All right, so this is the first tangency portfolio, and we call this optimal risky portfolio. All right, so if you want to find the optimal risky portfolio, you just need to actually maximize the Sharpe ratio of any risky portfolio, and if you do that, you're going to actually have the optimal risky portfolio. All right, so final question. So the answer, to question number 3 is the, optimal risky portfolio. All right, final question. How do we allocate between risk-free and the ORP? All right, the answer, it depends on the risk aversion of the investor. Okay, so if you are really risk averse, all right, you might want to put everything in risk-free asset and nothing at all in the optimal risky portfolio. All right, but if you're not that risk averse, you might want to entertain some risk in your complete portfolio. Okay, so if I want to actually replicate the second tangency, I showed you the graph already when I started this lecture here. All right, so we have just replicated this complete, optimal risky portfolio here. So now our objective is how do we actually identify this, optimal complete portfolio. Okay, this actually is the so-called optimal complete portfolio, or OCP. All right, so how do we do that? All right, so the answer is, it depends on the risk aversion coefficient. Okay, but in order for me to actually illustrate this, I would have to actually, involve some kind of utility function. Okay, so remember, investors actually derive utility from investing in complete portfolios. So I'm going to actually use the utility function proposed by the CFA Institute. All right, so this utility function says the kind of utility you derive from the complete portfolio is actually calculated as follows. Expect return of the complete portfolio, all right, minus a half times the risk aversion coefficient, code A, times the variance of the complete portfolio. Okay, so if you have a complete portfolio, if you have the risk and return profile, if you have the risk aversion coefficient, I can go ahead and calculate the utility function, calculate utility score. All right, so to find the optimal complete portfolio, we just need to choose the complete portfolio that maximizes the utility. All right, in other words, you actually derive the highest utility, and that's going to determine how much you want to allocate to risk-free, how much you want to allocate to the optimal risky portfolio. All right, so I'm going to use solver to find the OCP here. Okay, so optimal complete portfolio. All right, so I'm going to guess the weight on risk-free asset and the weight on ORP. All right, so now we're only focusing on optimal risky portfolio because we know that's the best choice out of all the risky portfolios you're going to actually be able to construct, all right, or be able to focus on. And I'm going to look at complete portfolio standard deviation, and I'm going to look at complete portfolio expect return, and more importantly, I'm going to look at the utility score, and I'm going to actually assume, all right, a risk aversion coefficient of let's say, what's the number here? All right, so let me just look up the number here. Risk aversion coefficient of 20. Okay. All right, so I'm going to actually look at the complete portfolio. So let me just say, how about 0.25 and 0.75? okay? And I can look at the complete portfolio expect return. So can I copy these two and paste it here? All right, so let me just double check. All right, so this is calculating the complete portfolio expect return, and that's 25% of weight on risk-free times the 2% plus 75% of the weight on ORP times D109. What is D109? That's the ORP expect return. All right, that's good. That's what we need. And let's look at complete portfolio standard deviation. So this is the sandwich formula. The weight matrix on the left, the variance coverage matrix in the middle. All right, this variance coverage matrix is actually using risk-free asset and the optimal risky portfolio. Okay, and yes, that's good. So now let me go ahead and calculate the utility. All right, so this is actually equal to expect return minus a half times risk aversion coefficient, which is 20, which is assumed, times the variance, which is the standard deviation squared. Okay, so that's the utility score. Now, is this the best one? Let's find out. All right, so I'm going to invoke solver. I'm going to maximize the utility, which is F145, by changing again. The portfolio manager can actually fine tune the weights. So that's A145 and the colon B145. All right, so that's going to be the choice variable for the portfolio manager. And we do have the constraint that weights add up to 1. So I should actually say sum of weights here because the way I actually guessed 2 weights. Okay, so they actually happen to add up to 1, and subject to the constraint that H145 equal to 1. Okay. All right, so let's actually go ahead and bring up solver here, and I'm going to look at, this is my utility score, and I want to maximize this. All right, so I want to actually change my choice variable here, and I do have the constraint, but I need to change the cell reference here. All right, so that's the summation of the weights, and that's what we need to do. Okay. And so I'm going to actually click OK or click solve. Solver says I found a solution here. All right. So if you want to derive the highest utility, you're going to put 35% in risk-free and 65% in ORP. All right. So the optimal complete portfolio has about 35% and 65% respectively in risk-free and ORP. Okay. It has expect return of 7.74% and 7.74% and a standard deviation of 5.3 6. I'm doing a rounding here, and maximized and provides the highest utility of 0.048487. Okay, so that is the optimal complete portfolio. All right, so now how do I actually plot this? Okay, so if I want to to plot the second tangency, all right, we need to actually construct something called the utility indifference curve. Okay, this is a name from your Finance 310, but I'm just going to ignore the interpretation because the video is actually getting a bit long. So I'm just going to go ahead and look at the indifference curve. I'm going to plot that curve, and when I do that, I'm going to have the tangency. Okay, so I'm going to look at complete portfolio standard deviation, and I'm going to look at complete portfolio expect return, and I know that the utility indifference, the utility indifference, score. All right. So all right. So I just need to plot the utility indifference curve. Okay. So for that matter, I just need to look at different complete portfolio standard deviation, and I'm going to look at the the complete portfolio expect return. okay? And, let's actually start with a very low standard deviation, which is 0.01, 1%, okay? And later, I'm going to look at another portfolio that actually has, 2%, standard deviation, and I'm going to actually look at, 4% here. And what did I do? All right, so I'm going to look at 4% standard deviation, and I'm going to actually copy this down here until I have 18% standard deviation. All right, so imagine many portfolios can actually do this. All right, can provide a standard deviation of 1% or 18%. The question is, if you want to actually make sure all these portfolios provide the same utility, what would be the expected return? All right, so the expected return would be equal to, remember, the utility function is actually equal to expected return minus a half times 20 times the variance, okay, of the complete portfolio. So from this, I can actually say expected return should be equal to, all right, the utility score plus a half times 20 times the variance, okay? So that will get me the formula for the expected return, all right? So I'm going to look at the utility score, which is actually this number here, all right? So this is equal to this number, all right? I need to lock down this number here because I want to copy it down in a second, all right? And this is actually, adding, a half times 20, that's the, risk aversion coefficient, times the, times the standard deviation squared, all right? So that's going to be the complete portfolio expected return. In other words, this portfolio, yes, this is actually one of the portfolios that actually provide the maximized utility score, all right? And I can actually copy this down here, and I get all the other complete portfolio expected return. And so this actually, if you plot this in a graph, you're gonna have the utility interface curve, all right? So now I'm going to plot these complete portfolios into the same chart, all right? So what am I going to get? All right, so I'm going to copy this and paste it here. All right, I have one more series to plot. So let me click right click and select the data here. And I'm going to actually add one more series. And let me just call this utility interference curve. All right, I don't have time to motivate the intuition for this utility interference curve, but you can actually draw this already with this Excel illustration. All right, so the X variables are the standard deviation, and the Y variables are the expected return. Okay, all right, and now I can actually click OK and click OK, and yes, we actually have the tangency here. All right, so that tangency portfolio is the optimal complete portfolio. Okay, and we have just replicated the starting chart I mentioned at the beginning of this lecture. All right, so if you look at this one here, yes, it's very similar. We have two tangencies. All right, so the final comment I want to make is using this illustration or this example. Consider an investor who has $1 million to invest. All right, what is his allocation, or what is his allocation, or I should say, how should this investor allocate between F, A, and B? All right, so that is the close, this is closing the loop here. All right, we have $1 million for us to invest, and so the investment is $1 million. Okay. All right, and this is our complete portfolio. Okay. All right, and we know that it's going to be, having risk-free. All right, dollar amount in risk-free and dollar amount in, ORP. Okay, and how do we do this? Well, we have $1 million, and we're saying if you want to actually have the, maximize the utility score, you're going to put 35% of that. So whatever that is, that's going to be the total dollar investment in risk-free. Okay, and by the way, I should say, assume the investor has a risk aversion coefficient of 20. Of 20, all right, that's the number we used. Okay, if the risk aversion coefficient is 4, you can actually see that this investor is actually less risk averse, so the investor should actually put more into the optimal risky portfolio. You can verify this. Okay, you just need to go through the calculation again and find the answer, and you should be able to verify that. All right, so the optimal risky portfolio should actually have $1 million, and the weight on that should be 65%. Okay, now this is risk-free and this is optimal risky portfolio. Okay, now out of the optimal risky portfolio, all right, so dollar investment in A and dollar investment in B. How do we actually allocate this? All right, so I have this total amount here. And I know that if I have these two stocks, A and B, to invest, then the optimal risky portfolio has a weight of 52% in A. All right, so I'm just going to multiply that number by 52%. And, the investment in B is going to be whatever I have for the ORP times the weight on B in the ORP. And that's the number here. All right, so I'm going to actually, and I can actually look at the total. All right, so how much is it? So I have this amount investing A, investing risk-free, this amount in A, and this amount in B, and yes, they add up to $1 million. Okay, there's a little rounding issue, but that's okay. All right, so this completes the discussion for modern portfolio theory. All right, I understand that there's a lot for you to actually take in, but if you can actually plot these two tendencies, then your understanding is really rock solid. Okay, and that's the beauty of doing everything in Excel. All right, I should say plotting the two tendencies. Okay. All right, so that concludes my discussion for the modern portfolio theory, and this is also the last, video lecture for this class. All right, and if you have any questions, please let me know. Okay.